Hey folks, this is Jeff Camarda, PhD, your wealth doctor with must-knows about these big tax law changes. Will they harm your wealth? Tackling the labyrinth, there's a word I use very often, the labyrinth maze of U.S. tax regulations to file your return can already be headache-inducing. However, brace yourself for impending tax-related stress emanating from Washington in the near future, or really Washington's gridlock. By December 31st, 2025, not so far away anymore, crucial elements of the 2017 federal tax law, the Tax Cuts and Jobs Act, are set to expire. Once its deadline hits, these provisions will revert to their pre-17 state, effectively undoing the sweeping changes and many tax cuts introduced during the initial year of the Trump administration, the first Trump administration. Essential aspects of the tax code will be open for reconsideration, from tax rates and standard deductions to the treatment of business income, exemption limits on significant transactions like inheritance or gifts, and deductions for state and local taxes. If Congress remains inactive, and my money's on inactivity, especially the way the political wind has blown strong over the past few years, the tax landscape in 26 will abruptly revert to its pre-17 configuration, potentially leading, I think certainly leading, to trillions of dollars in additional liabilities for taxpayers and a corresponding increase in revenue for the federal government. Adding to the complexity, the pre-17 tax code factored in provisions for future inflation adjustments, further complicating estimates for crucial elements of the federal tax bracket if the law sunsets as planned. And as planned, I mean, that's the existing law. Unless they change the law, this is happening, folks. And I really doubt that they're going to get into Congress in the next couple of years. Merely preserving the current tax code might appear to be a more manageable option. However, the Congressional Budget Office estimates that retaining all expiring or less generous provisions could cost a staggering $3.5 trillion by 2023. And as you know from my other videos and writings in wealth education, I think the federal government is on a tragic trajectory to hit the mountain, with costs of entitlement programs, Social Security, Medicare skyrocketing, the deficit just mounting beyond World War II levels, projected actually double to that level pretty soon, and tax revenues not nearly making up the gap. So this impending tax upheaval system stems directly from the 2017 tax overhaul. While most Americans experience tax reductions, residents in high tax states face increases due to the $10,000 cap on state and local tax deductions. Repealing this provision would be welcome news for affected areas. Nevertheless, the overall impact of the tax overhaul lightened the tax burden for most of the nation, albeit at a considerable expense, as we just highlighted. This slow-moving tax storm is a direct consequence of the tax overhaul of 17. For most Americans, but not all, taxes decline. Many people in states with high state and local taxes experience tax increases because state and local tax deductions were capped at $10,000. That's the infamous SALT cap. The expiration of that provision would be good news in those neighborhoods in most of the country, but the net effect of the tax overhaul was a lightened burden. This largesse made the tax law expensive on a gargantuan scale. Congress estimated that it would cost the federal government $1.5 trillion in foregone tax revenue by 2027, but Congress offset the cost by building in the December 31st, 2025 expiration, a delayed series of tax increases for most people in the country, starting in 2026, if it's allowed to, the law doesn't change. In 2025 or sometime in 26, if Congress's aversion of meeting critical fiscal deadlines is any guide, congressional leaders and the next president will be thrashing out a solution to the entirely predictable tax dilemma. Whoever the politicians are, they will try to avoid tax increases and probably also try to avoid increasing the budget deficit much, in no small part because of the 17 tax cuts. The deficit reached $1.7 trillion in the 2023 fiscal year. Some kind of tax deal will eventually be reached, I think, maybe, but it's far from certain. But I really have no idea what the tax code will look like in 2026. In an ideal world, you wouldn't run a tax system that way, but this is what we're stuck with. Aside from the cap on state and local reductions, here are the highlights, the important stuff, of changes in the tax code scheduled to take place January 1st of 26 if there's no change in the law. The marginal tax wage will increase. The highest rate will rise to 39.6% from 37%. That's on top of FICA taxes, payroll tax, other stealth taxes. By the way, that's just the basic highest bracket rate. The income levels for 7 tax brackets will be lowered, raising tax liabilities for millions of people. The cost of extending this part of the tax law is $1.8 trillion. The standard deduction for 2024, taxpayers can deduct $14,600 if they're single, $29,200 if they're married and file jointly. About 90% of taxpayers now use this deduction, the standard deduction. Before the 2017 law, the standard deduction was just $6,500 for single taxpayers and $13,000 for those who file jointly. In 26, the standard deduction would return to the old levels, plus inflation adjustments, which are nominal, which means your standard deduction is going down big time. The cost of extending this is about $1 trillion. Child tax credit is $2,000 per child for those who qualify. Pending legislation would increase it through 2025. It's scheduled to be dropped in 2026 to $1,000. The cost of an extension is $600 million for this. This is a big one for a lot of Camarda clients and Taxmaster clients. The business pass-through deduction, the Internal Revenue Code section 199A, it allows some self-employed people whose business income passes through, this is a lot of people who passes through to the personal return to deduct up to 20% of qualified income. Basically, you get a pass on a fifth of the income from most businesses. She's not taxed at all, that's what that means. After sunset, their individual tax rates would be imposed. The cost, basically, you're going to pay tax on the entire amount. That deduction disappears. It also costs the federal government about $550 billion if it's extended. The alternative minimum tax was originally intended to make sure rich people paid at least some income tax. It affects very tiny percent of taxpayers, but would be applied to like 40 times as many as currently after sunset, according to the Nonpartisan Tax Policy Center. The cost of an extension of that, if they don't, if they allow the existing law to not sunset, would be about $1 billion. Finally, near and dear to my heart, estates and lifetime gifts valued at $13.6 million are exempt. That's per person currently. With a sunset, those numbers would drop to about $5 million per person, plus an inflation adjustment. And this is a really, really big deal for many of you watching, because to the extent that you haven't done the right estate planning and got assets out of your estate tax-free, the tax-free amount is going down big time. So action soon and quick action is required if you may be exposed. If you're worth more than $5 or $6 million as an individual, or expect to be, at your life expectancy. A shift in the estate tax threshold could create a grim the rich person's problem. You might save a ton of money by timing the death of a wealthy benefactor very carefully over the next couple of years. The same is true for gifts. If you have millions of gifts to bestow, it might be smart to accelerate your gifting and set up the appropriate trusts and so forth. Effective and humane tax planning requires some sense of what the tax code will look like in the years ahead, but it's exactly what we don't have. We don't have clarity. Best to plan for the worst, get the planning done, and get that stuff out of your taxable estate. Shifting income and, let's say, taxable events like the death of a rich aunt from 2026 into 2025 might save you some money, assuming the current tax rules expire on schedule, but Congress might well step in, taxes might not rise, and your various efforts could be a colossal waste of time. However, I still think the planning is very prudent. Plan for the worst case scenario. If you have the trust set up properly, you really still have enough access to the money not to notice very much, as well as upsetting your dear aunt whose demise may be accelerated for tax reasons. In fact, tax rates could be cut again, and the budget deficit might swell much further. And even if it seems rational that they won't, much depends on the nation's elections. American politics is obviously not very rational. That much is clear. The best you can do is apply extensive tax expertise to develop all-weather tax reduction solutions, like the kind Camarda and Taxmaster is very passionate about building for clients. If you listen to the end, thank you so much for your stamina. That's it for now. Thanks for watching. This is Dr. Jeff Camarda. Until next time, we'll see you.